Hello and welcome, traders. I am Rachel Deshelle, Senior Manager of Trading Services and your host for this long options webcast. Now, in this webcast, we make the assumption that you are already familiar with the basic concepts of options. If you're not, you're more than welcome to stay around, but you may want to start with the getting started with options class first. Now, I am joined in the chat today by my good friend Kevin Horner. He will answer any questions that I cannot get to during today's session. So be sure to put in your questions, comments, requests during the session in that chat box today. Please give us both a follow on X. He is Kevin Horner CS. I am Rachel CS. We post a lot of charts, a lot of different ideas. If you follow me, you've probably seen me post quite a bit of charts today, as we're always looking at the market here. So, and also, if you like this video today, please give it a thumbs up. Please subscribe to us on Trader Talk Schwab Coaching. Now, I'm excited for the topic that I'm bringing to you guys today. There was a couple different survey requests for that one. I've kept an eye on the chat. I've kept an eye on my mentions on X, and a few people have been asking for a synthetic option strategy. So we're going to go through long option synthetics today, go through the basics of those. But before we get started, let's cover some important disclosures here. So keep in mind that options carry a high level of risk and are not suitable for all investors. The information that we're going to cover today is for general informational and educational purposes only and should not be considered any type of recommendation or advice. And we're going to go through the paper money software application. Keep in mind that there are some differences between paper and live as we go today. Now for our agenda, we are going to get into our market overview first, like we always do. We're going to review the past trades that we have on. Then we're going to get into discussing the concept of long options with those drivers of price, time, and volatility that will all impact the value of our options. And then we're going to end our class by placing some example trades on the paper money platform. So let's dive into Thinkorswim and let's talk about what's going on in the market. So we made yet another all-time high today in the S&P 500, which you can see there marked on the chart. Now, a couple different things that we're kind of seeing stack up here. We did have quite a bit of a bullish push earlier this morning. Now price is giving a little bit of pullback here, creating almost like this doji type candlestick formation, which tells us that well, first of all, I'll mention it's a possible doji at this point because there is still about 3 hours of trading left in the day. So it really is going to depend on what the closing price does and what the price of the index essentially does tomorrow that will validate this being a possible doji type candlestick. But the fact that we're having a doji candlestick occurring right at new all-time highs, right at a level of prior resistance, could tell us that that is a meaningful type of formation, forecasting that we may have a little bit of indecision, a little bit of pause, or maybe even a possible reversal at these levels. And we're certainly seeing breadth kind of show up with the same type of indication here. So we're seeing a little bit of a divergence in breadth. We're seeing a lower high being made on the advanced decline line for the New York Stock Exchange. So just that difference of advancers versus decliners. So seeing a little bit of a breadth divergence, it's not terrible. We're still seeing breadth really close to those all-time highs, but the divergence is noteworthy here. So if we do see price, the market, to the S&P 500 print this possible doji candlestick where the open and the close are roughly at the same level, and we see some follow through to tomorrow, maybe some bearish follow through, we may see price find a familiar level of support, probably right around this 20-day moving average, which comes right into play with that confluence of those prior levels that we saw here. So really that level right around 73.50 or so could be this possible level of support. If we did see a little bit of a pullback, we're going to measure how far that would be. that's about roughly 2%. That is not terrible at all. So that's just a teeny tiny little pullback. If we're going to see that, that could be where price may find itself. So now, as far as our session today, let's first review some of our old trades. We had a leap trade that we placed a couple weeks ago on Oracle. So we're just going to expand this here. So we had the 17th of June, 2027, 180 strike call. We are still up on that position. We're up about 12% on that one. And I'll just show you the price chart of Oracle to just show what exactly we were looking at here from a technical basis. So what we're really looking at here is we had a little bit of a double bottom, then we had a little bit of a retest there on the double bottom. And then it looks like right now price is possibly carving out this maybe cup and handle pattern that we're seeing here. So you have the cup taking shape, possibly the handle right here with resistance up above 200 or so. Right now it's looking like we have a little bit of a bearish engulfing candlestick, so maybe we see a little bit of a pullback and a retest to this level right around 180 or so. Maybe that's what we see. But again, we do have a leap option, so we have over a year in time on this option here. So we're kind of treating it like the long stock in this case. Now, as far as our synthetic option strategies, today we're going to talk about a few different things. We're going to talk about what synthetics are. We're going to analyze the risk profiles of each and compare a synthetic long call to a long call trade and a synthetic long put to a long put trade. And we'll talk about why traders may choose one or the other. And then what we're also going to do is talk about all the differences that you're going to see in capital requirements, in dividends, in your volatility, and in your Greeks, and how those are all going to differ. And then we're going to talk about some of the different trade-offs. So the first thing that we're going to kind of pull up here on our whiteboard is going to be what a essentially synthetic long call is. So a synthetic long call is essentially just taking a long put option and pairing it with long stock to essentially create the same profile as a long call. So if you take a long stock position, you essentially have let's think about the risk to reward to this one, or about the max gain, max loss. If you take a long stock position, you have risk all the way down to zero. So you don't necessarily have unlimited max gain, or max loss, but you have max loss down to zero if the stock goes to zero. And then you have unlimited max gain with the long stock. Now with the long put, you essentially are going to have your limited upside on the option, and you're essentially only going to have max gain essentially down to zero. So when these two pair up together, they're going to have the same profile as a long call option. So you're actually going to have limited downside risk to a certain degree, and then you're going to have unlimited upside potential just with those two mixed together. So we'll look at an example in a few minutes there. Now we're also going to talk about a synthetic long put. In a synthetic long put, it's just the opposite of a long call. We're kind of going to look at what a long call would be plus a short stock position. So if we think about the risk profile of a short stock, and keep in mind that there are risks when it comes to shorting stock, you have the possibility of that stock possibly going up to infinity against you. So there's unlimited max loss in that scenario. And then you have the gain if the stock goes down to zero. Now, with a long call option, we just talked about the risk profile of that. So you have limited loss potential, you have unlimited upside gain. So what you're essentially going to get is a synthetic long put. So you're going to get limited max gain if the price of the stock goes down to zero, and limited loss potential as well, with just the essentially the premium is what you would see between the two. So that is essentially what we're looking at. And I have a couple questions here in the chat. With Josh mentioned synthetic long call, same as a married put. Yes, it is. And we will actually take a look at these on the risk profile. So I'm going to show you a couple different examples. We're going to start with the charts just like we normally do, and then we're going to build some of these trades and compare. So what we're going to do first is look at an example on this essentially on a long call position. So we're going to look at Applied Digital, and I'm going to take APLD in this scenario. So APLD, I'm going to take this off the chart. We have essentially this range or this double bottom pattern that price recently broke out of and made its way to new all-time highs. Now, right now, if we look at the implied volatility, which is, one of those characteristics that we essentially look at with a long option, because we want to make sure that we are essentially positioning ourselves in the right type of volatility regime when it comes to long options. Typically, long option buyers want to essentially take a long position, a long directional position when volatility is at some lower levels than they've possibly seen. We've talked about wanting to possibly avoid earnings announcements and things like that as well, just because we see that influx in implied volatility. We know that when we have higher implied volatility, we're going to have higher option premiums as well. So typically we want to buy low, sell high. So that's just one of the examples of why we may look at some lower levels of volatility or lower volatility regimes when it comes to buying options. Now, in this case, this is a stock that has a pretty constructive bullish reversal pattern that could possibly put that stock at a much higher price if you kind of take a measured move from this. Now, I know this isn't a price patterns class, that comes tomorrow, but if we take a measured move of the depth of this pattern that we're seeing, which is roughly $23, and we place that at the breakout point, we know that price has taken about 8 months to reach these levels, or 8 months to essentially craft out this pattern. So it could roughly take 8 months for the price of the stock to go to 64 or so. We've seen that it's traveled quite a ways already so far. So a lot of times when you're seeing kind of these price patterns, price formations, you may actually see price reach these levels a lot quicker than originally expected, especially if momentum is strong. So for a target trader, they may look for kind of a level up here near 64, but we are going to be a trend trader in this scenario and essentially trade this trend. So we're going to look at a couple different examples of a synthetic long call mixed with just a regular long call. So let's take a look here. We're going to take a look at just a shorter term trend trade in this scenario. So we're going to look about 2 months out from expiration, in this case at the 17th of July. Now, we saw that implied volatility on the other chart as well. You can see down here the current implied volatility percentile is about 20. You saw that it was relatively low. This shows us that it's in the lower fifth of where implied volatility has been over the last year. So what we're essentially going to do is we are going to look at the 52 days out from expiration. We're going to take a look at our option here. Now, in this class, we talk a lot about looking at volume and open interest and the width of the spread with the options to make sure that it is a liquid market for us to be trading these options. And we can see here on the call side, we can see that there is clearly quite a bit of volume and open interest. It's a little bit lighter on the put side, but if you look at the width of the spread, it's still relatively tight. We're going to look at less than a 10% spread on the bid and the ask, because that's going to tell us that there is still quite a bit of a liquidity there. So what we're going to do first is we're going to follow our example rules that we normally do for a long call option, and we're going to look at a delta of roughly 60. We're going to look a little bit in the money here. I'm actually going to go, yeah, we're going to go to this one here. It looks like there's a tighter spread on this one. So we're going to look at the 46 strike call with a delta of roughly 59. So that tells us that per $1 move in the stock, our option should theoretically move about 59 cents. Now we have about 7 cents in time decay, which tells us with each passing day, we're going to see about 7 cents in time decay. And then our vega, or our sensitivity to volatility, tells us that if we have a 1% increase or decrease in implied volatility, our option's theoretically going to move up or down 7 cents. So what I'm going to do is I'm just going to pull up this order for a possible long call trade. And I'm going to right click on this order and I'm going to analyze the trade. And so that's going to take us to our risk profile graph. And let's just type in Applied Digital. Okay, perfect. So just as a reminder, when we're looking at the profile of a long call option, we have limited risk to the downside. Our max loss is what we're paying for that option. Okay? And our break even is essentially where we are, where the price of the stock is, plus the price of our premium on expiration. So that is essentially where the price of the stock needs to be by expiration above 53.56, where that gold line is, for us to break even. And then we have maximum unlimited gain because the price of the stock should theoretically go up to infinity. So we're going to compare this and all the deltas, the gammas, the thetas, the vegas with what would be our synthetic long call option. So we talked about how when we build a synthetic long call, we're going to look at going long the stock. So I'm actually going to add 100 shares of stock here, and I'm just going to click Analyze Trade just to add it to our little window here. And then we're going to look at the same strike price, but on the put side. So essentially a married put in this scenario. So I'm going to right click on this option and analyze the trade. Okay. Now, if you guys notice underneath, see that I unchecked the long call option and I checked the put option as well as the stock. And what I want you guys to notice is that that break even is almost roughly at the same price. So when you take a long call option and you compare it with the long stock and a put option of the exact same strike price, you're going to get roughly exactly the same risk profile here. Because again, you are essentially capping your downside with that put option because you're saying, I have the right to sell this stock if it drops below a certain price. And in this scenario, we're saying we have the right to sell this stock if it drops below 46. So if we have 100 shares and it drops below 46, well, that max loss is going to cap us out right around 711. And so if we switch back to this other long call that we saw, you have that same, almost the same max loss, not quite this exact same, but close enough. You're going to have roughly about a $755 max loss. Now let's swing back to the synthetic long call option. You're going to have roughly the same break-even point because of put call parity, you're essentially going to have that same amount of extrinsic value, or roughly the same amount of extrinsic value in the put option as you are in that call option. So keep that in mind. That's why these two are so tightly conjoined in this case. But essentially that is what you're kind of seeing here. And I see some questions in the chat. There was some confusion about what a synthetic long was. And a synthetic long, that's you're saying you're synthetically long the stock. So I'll actually show you a synthetic long if you guys want to see that as well. So when you think of the risk profile of a stock, notice that it's a complete diagonal line. You have the max loss down to zero. If the stock goes down to zero, you have unlimited max gain. And so if we did the same thing with let's say with a synthetic long, taking a long call and a short put, well, let's take that long call and I'm going to add a short put of that same strike. And we're going to analyze that as well to show you guys. Okay, so notice that I have those two selected. We have the long call and we have the short put. Notice how that profile is exactly the same as what we saw on that long stock, because you're taking two bullish trades. Kind of think of just the nature of both of these trades. You're taking two bullish trades here and pairing them together, which is essentially why you're getting this same profile of the long stock in that case. When you're crafting a long call or a long put, you have that limited downside, but you have a directional bias. And so when you're looking at the formula of those individual kind of components that make up a synthetic long call or synthetic long put, keep in mind this is bullish, long put is bearish, and a long stock is bullish. Okay, so you're taking a bearish trade, a directional bearish trade, paired with a bullish trade, but because of the directional bias of that long stock, because the delta is so much greater, that is why this ends up being a long call. We're going to talk about this in just a second. Same with the long put. We are taking a bearish position by going short the stock. We're pairing that with a bullish position with going long the call. And because the strong directional bias of being short that stock, because the delta is so much larger in that case, that is why it's creating this synthetic long put. You still have your capped essential kind of downside in that case with that as well. So yeah, and Josh, you are right. Essentially, lots of different ways to put together the same trade. So, yeah, synthetics, they kind of go to the concept of a call is a put and a put is a call. So there's so many different combinations that you can make with these. You can do synthetic, like straddle positions, synthetic vertical positions as well. So so many different types of ways to pair different option strategies, just the basics of these option strategies to actually mimic the same profile of different strategies as well. So I'm going to get rid of this trade since that was kind of just answering a question in that sense. So I want you guys to keep in mind, if we look at this delta, and I'm actually going to put this at a 0 offset here. And I want to, here we'll go that way. Okay, so we're going to take a look at the current Greeks of what this strategy would actually create in this sense. So if we look at the Greeks here, we can see that there's a delta of roughly 57.74. So we have a delta of roughly 58 on this long call option. So this is just the basic long call option. Now, if I switch to our long stock and long put, you'll notice that delta is the same in that case, okay? So the delta is going to be the same. Now, if you wanted a little bit of a higher delta in that case, you could go to, let's say, a deeper in the money option. So you could go a little bit lower on the put, and you could take that put to about 48 or so, or I guess I'll actually move that. Actually, the put side is going to be, there's going to be a little bit of a skew there. But essentially what you're seeing here when you're looking at this option, you're seeing the same amount of delta, okay? Because you're having the stock with a delta of essentially 100. So I'm going to take that and show you. The stock's going to have the delta of 100. And because the put has a negative delta of about 42, because we know that there's a little bit of skew with the deltas on both the calls and the put side. We know that the deltas actually are more sensitive on the call side. You'll actually have a larger delta for a slightly in the money option than you would for a slightly in the money put option. So you'll notice that the delta here is going to be a little bit smaller in that case for the same strike price that we're seeing. So that's why you have that stock with a delta of 100 netted with the delta of negative 40 and some change, roughly giving us the same amount of delta that we would see on that long call option in that case. Okay. So another thing as well. So we're going to take a look at the theta. Okay. So the theta decay. Keep in mind that when we are along the stock, there is no expiration. We do not have any theta decay whatsoever. So the theta is being essentially driven by that long put option. And we know that because of that put call parity, those options of roughly that same strike are going to have roughly that same amount of theta, especially for an at the money option. For an at the money option, that's where it becomes most prevalent. So you're going to have the same amount of theta there. And then when we're taking a look at, let's say, the Vega, you're essentially, you don't necessarily have that sensitivity in the price of the stock to that Vega, because essentially that stock is just going to basically move on volatility alone, move on trend, supply and demand, and some of those factors like that. So the put option is going to be really your driving force for that Vega in that case, very similar to what you're seeing here on that long call option as well. So in this case, what we're going to do is we're going to place the synthetic long option for Applied Digital, and we're going to move into essentially that synthetic long put. So what I'm going to do is first take this 100 share order for the stock in this case, and I'm going to place this order first because I don't think it's going to allow me to do these together. Actually, yeah, I don't think it's going to allow me to do these together. We may be able to do this with spread. So if you go to spread, let's see. Okay, so you can actually do this on a synthetic here. So if we do, let's see if this allows us to do this. So we're going to take the long put. Yeah, it's not going to allow us to do that either. Okay. So what I'm going to do is essentially just create these as two separate trades. So I'm going to place the order to buy Applied Digital for the price of 100 shares of stock in this case. So I'm going to hit confirm and send. I'm going to place this in our long options class. We're using a limit order to have control over the price. And again, this is staying within our risk parameters here within our account. So we're going to place that order there for Applied Digital. And then we were looking at the 46 strike put in this scenario. So again, another one where it's still staying within the risk parameters of our account. We already talked about how the most we could lose is about 710. The most we can make because of that long stock is up to infinity in that case. So it doesn't necessarily cap us out. So we're going to place this order for that long put option. Okay. Awesome. So we have that synthetic in and working. Now let's take a look at a different example. We're going to first start by looking at the charts like we did on the last one. And we're going to start with a stock that has been in a little bit of a downtrend. So when I was looking through charts, there was a lot of different bullish setups, and that's just kind of the characteristic of the market. So this is one that I actually found that has a little bit of a bearish tilt to it, I would say. We're still going to be monitoring the implied volatility as well, making sure that we're in a favorable volatility regime or a lower volatility regime when it comes to our nature for option buying in this scenario. And if we take a look, we can see that there has been a level of support that has been breached here. So we had a little bit of almost like a head and shoulders type pattern where we had the left shoulder forming here, the head, very large right shoulder, so it doesn't fit a lot of the rules of a true head and shoulders pattern, which is probably why we saw a little bit of a false breakdown here in this scenario where price re-entered back into this pattern. But nevertheless, we still have a downtrend that is still intact. So we still have lower highs and lower lows in this case. So price could run up into a little bit of resistance here, and it is showing a little bit of a possible reversal candlestick pattern today with that doji. Now, even as we speak, forming maybe a bearish harami candlestick, possibly. So that could give further downside to these lows that we just kind of carved out mid-May in this sense. So essentially, we're going to take a directional bearish trade. We're going to talk about some of the different mechanics. And so what I'm going to do is we're still going to use the same rules that we did before. So we're going to look a couple months out from expiration. We're going to look at the 17th of July here with 52 days left until expiration. We are going to look at a put option that is slightly in the money here. Now you'll notice that these spreads are a little bit wider. They're still close to being within that 10% range here, but I'm still just using this one as an example. I'm not going to essentially place this trade, but I'm just going to use this as an example here. So just kind of be wary if you are following along with this trade. The spreads are a little bit wider. There is lower liquidity if you notice with the options as well in this case. So if we look here, we're going to start with just a possible bearish trade. We're actually going to look at the 150 strike. Okay, so we're going to look at the 150 strike and we're going to analyze this trade similar to what we just did. So we know that with a put option, we'll do a little bit of review of this. We know that with a put option, our risk is limited to the downside with our max loss essentially being that premium that we're paying. So our max loss is going to be roughly $350. So that is the most that we can lose on this option. Now, when we're talking about calculating a break even for a put option, we remember that it's call up, put down. So we take essentially the strike price minus the premium, and that is going to give us our break-even slice or a break-even price on expiration. So I'll put that line, that slice right to our break-even line on expiration. And essentially this is telling us that price needs to go below 146.49 for us to be able to break even here. So I'm going to add a couple other trades. We talked about how a synthetic long put is essentially being short the stock and being long the call. Okay, so we're going to essentially go short the stock in this case. So we're going to analyze that short stock. I'm going to build that to analyze the trade. And then we're going to go long that same strike for that call. So I'm going to analyze that trade there. Okay, so we notice the same profile that we just saw before. So we have almost the same strike price. We have almost the same downside risk. So before it was 350 to the downside, here it's about 400 to the downside. Our break-even price rises just a little bit, just because the premium is a little bit higher on the call side. You're always going to typically see that when you're looking at those at the money options specifically for call options versus puts. That's just due to the natural directional bias of the market in a stock. But essentially, you're seeing this similar thing. Now, I want to call out a couple different reasons of why people would do synthetics or why traders would do synthetics, because I think we already kind of ran through that the Greeks are going to be roughly the same when you're looking at synthetics. Obviously, it's going to be different from the long or short stock versus long or the call or the put. So we kind of showed a little bit of the comparisons there. But essentially, let's kind of talk about why people would use a synthetic option versus just a regular long option. So when it comes to the puts, um, there is a lot of times short sale constraints when it comes to put options. So if short shares are maybe hard to borrow or expensive to short, that is why a long put may just be simpler in that case. If you don't have any short share type of restrictions, maybe you look at using this synthetic option, but a lot of institutions will use synthetic options strategically as well. And then one major downside to a synthetic long put option is keep in mind that when you are short shares, you actually owe the dividend. So when you're long shares through an ex-dividend date, like you would be for the synthetic long call, the huge benefit of that strategy on the flip side of it is that you're actually entitled to the dividend. So for a long call type of synthetic strategy, that's where a synthetic would actually benefit you over a traditional long call, because yes, you have maybe more capital outlay on the long stock position, but essentially you still have the right to that dividend if you own those shares before the ex-dividend date. And on the put side, that's kind of the downside of this synthetic long put strategy, is that you are essentially going to be owing that dividend. If you were short those shares right before the ex-dividend date, you need to owe that dividend. So keep in mind that that is one of the downsides with this strategy as well. And then I guess the other kind of point here would be volatility sensitivity as well. So, um, just kind of a standalone long put or long call would be pure Vega exposure. But with the short stock or the long stock, which has no Vega, that kind of may, in some environments, depending on the volatility environment, a synthetic may be more efficient in that case too. So we've showed that the Vega is roughly the same, but depending on the volatility environment, you may see a little bit of disparity there, a little bit of beneficial nature towards more of the synthetics in that case. And then with let's talk about like just long call synthetics. You essentially, in that case, you don't have to necessarily worry about exercising an option or anything like that because you're long the shares. So keep in mind, there are just some minor differences like that. The major one, though, that you're going to want to keep in mind with these synthetic strategies is that dividend component and also the voting share rights component. So I forgot to mention that, but those are kind of the two main components of why you may favor a synthetic strategy over a long synthetic is just the voting share rights, maybe that dividend whenever an ex-dividend date is coming up, and then in some volatility environments you may see some differences there. So let's take a look. Okay. Perfect. So I am going to keep in mind just the chat and keeping an eye on some of these different questions. And I see that Kevin, thank you so much, Kevin, for reposting that survey multiple times. If you guys can just take a minute to fill out that survey, actually, it'll probably take about 20 seconds or so to just fill out that survey. I definitely read all of your comments. That's why this class today is being brought to you, because there were a few comments on just asking for maybe a lesson on synthetics, and we can certainly cover more in the future as well. But let's take a look at some of these questions here. So Chris said, what is the logic of opening a position as a synthetic long call versus long put? I can see creating it as protection to reduce delta of an existing position, but it seems expensive for a new. So I think I may have just answered that question, Chris, when I talked about just kind of if you want to be entitled to a dividend with, let's say, that synthetic long call, you're giving a little bit more capital outlay, but essentially you are being entitled to that dividend, you're being entitled to those voting rights. But the downside of that, of course, is that there is a higher capital outlay in that case, and then kind of vice versa for the put option. So yeah, so that answered your question there. And then Morning Rush asked, will you teach level 1 strategies sometime? Let me know what you mean by level 1 strategies, because I know in this class we focus primarily on long options. So we take this class many different directions, and I think today was a really great direction to kind of bring this, since I haven't taught on synthetics yet. So just kind of different creative ways to bring maybe a new concept to long options, but we're always going to essentially cover something in the realm of long options there. You may want to check out our Getting Started with Options playlist, because that may be some other strategies there, some more simple strategies. So let me know if you guys have any more questions. Any more questions in the chat? I don't see any others. Well, thank you so much, everyone, for all of your questions today. Thank you for filling out that survey as well. Kevin, huge shout out to you. You've been so busy in that chat. Please give him a big follow on X. He is Kevin Horner CS. I'm Rachel Dash CS. And if this class was helpful for you today to learn a little bit more about synthetic long options, please give it a thumbs up. Please subscribe to us on Trader Talk Schwab Coaching on YouTube. Thank you, everyone, and see you later, traders.